Are you feeling ignorant about your own hotel's financial well-being? Would you be able to detect danger signs in the financial health of your hotel? Were you aware that picking up these danger signs in your hotel's financial well-being is a critical skill for a hotel manager, and it is guaranteed to get you elevations and promotions, ultimately success. However, most hotel managers have no understanding of the financial health of their hotel. Ability to detect early warning signs is actually a leadership strength. But most hotel managers tend to ignore this critical leadership strength. Because of that, their promotion and elevation opportunities become limited by their own actions. I will show you how you can easily identify early warning signs of your hotel's financial health. You would want that, right? And we'll be using a very simple technique. However, your peers would not know about this, so you will have a head start on them. And this technique will boost your chances for promotions, elevations, and all kinds of opportunities. Now, you may have a question. Why me? I spent 26 years in the hotel industry in senior finance and leadership roles. I have myself detected hundreds of early warning indicators. Moreover, I have personally shared this with hotel managers and got them to identify them too. And that led to successful analysis and successful financial decisions. Would you not want to be warned ahead of time about something affecting your business performance, what I call early warning signals? Particularly if it's about the long-term sustainability of your business. What is long-term sustainability? Well, in other words, whether the hotel can survive over the long term. Solvency ratios provide just that. They are early warning signals. But what are these solvency ratios? Let's take a look at one of the most important solvency ratio, called the interest coverage ratio. Interest coverage ratio is considered a solvency ratio. We shall see shortly what is solvency. It actually is using two important KPIs or key performance indicators of a hotel. The first one, EBITDA, or in layman terms, earnings, and the other one, interest expense. We shall know more about this shortly. So what is EBITDA? Well, EBITDA is, as is being pointed out, a form of earnings. There are a couple of forms of earnings, but this is one of them. And we'll see later specific definitions. EBITDA is also earnings before interest, tax, depreciation, and amortization expenses. As we said, interest coverage ratio is a solvency ratio. Now, what is that solvency ratio? Well, it measures in layman terms whether your hotel is able to pay off the interest expense on the borrowing that it has made. So solvency, in other words, could be related to the long-term health of a business, or as we said before, whether the business is able to survive over the long term. Now, survival ability of a business is linked to risk. There are risks inherent in a business, and hotel uses assets to remain in business in order to earn revenue. But on the other hand, liabilities create risk in the business. We shall see shortly how. And one major type of risk or liability is debt, or what is known as long-term borrowing. Now, debt brings this major risk along. So you may want to know, what is this major risk? Well, it is the possibility that you may default in the payment of interest on your borrowing. And thus, that risk is related to earnings. However, in the hotel industry, earnings go up and down because it is a seasonal industry. And it is this earnings going up and down that cause risk. Let's understand now the two terms necessary for our interest coverage ratio formula: interest and EBITDA. So what's the formula for the interest coverage ratio? Interest coverage ratio is calculated, and in our case, we are going to be using the 2019 current month numbers to calculate the ratio. Number one, EBITDA, or earnings. I shall shortly define that in detail. EBITDA is number one, as is being pointed out. divided by number 2, interest expense, also being pointed out. If we assign numbers to 1 and 2, we will arrive at 3.22 times. So what does interest coverage ratio of 3.22 times actually mean? Well, it means that Paradise Hotel earnings or EBITDA are able to cover its interest expense to the extent of 3.22 times. Now, how many times EBITDA covers interest expense is primarily what interest coverage ratio is all about. In our case, or in the case of the Paradise Hotel, the interest coverage ratio is not very good. Why do we say that? Well, it's because it's able to cover, that is, earnings are able to cover only 3.22 times interest expense. So your next question would be, well, why is it not good? And that is related to industry norms for interest coverage ratio. And what is the industry norm for the interest coverage ratio? Well, the norm says that interest should get covered a minimum of 4.00 times. By virtue of Paradise Hotel interest coverage ratio being only 3.22, this is below industry norm, which is why we say the interest coverage ratio is not very good. When we say it's not very good, we also mean that it is causing risk. And what could be some bad effects of an interest coverage ratio below 4.0, like the one in the case of the Paradise Hotel? Well, the most critical risk is that of defaulting in payment of interest. And this is if earnings fall further. So currently you notice that the interest expense is at 280,000 while the earnings are at 670,000. Let's say the earnings in a month are dropping closer to some 300,000. There could be a genuine risk that the hotel may not be able to pay interest costs. Now, interest is very closely linked to the borrowing made, which is called debt. And let's see what that debt is, and also we'll see what earnings are in terms of EBITDA. Debt is simply a long-term borrowing on a mortgage made by the hotel. Now, the business borrows money from third parties, and there are 3 important features of such a debt. Number 1 is long-term borrowing. It's not short-term borrowing that is considered debt. Debt is also a term loan of fixed amount. That's why it's called a term loan, and it's of a fixed amount. And finally, this loan is secured by a mortgage on the assets of Paradise Hotel. So you could say debt is a form of financing, and always this form of financing brings with it risk. Let's now understand what earnings are, or EBITDA, which we described earlier. Now, EBITDA for a business, it could be called the net operating income. There are different types of net operating income, but this is one of them. You could also say it is simply operating income before deducting expenses like interest, tax, depreciation, and amortization. As I said earlier, you could call it net operating income. And what are 3 important features of earnings or the EBITDA? Well, the first one is that it is affected by seasonality. Earnings are affected by seasonality. How? Well, you could have earnings which are high in peak months and low in lean months. And so you could say occupancy, revenue, profitability all fluctuate. They are high in peak months and low in lean months. So EBITDA is a KPI that owners look very, very closely. Now, interest coverage ratio is normally always monitored along with the debt equity ratio. And we understood that just a while back as the long-term borrowing on which interest is paid. Now, let's recap the interest coverage ratio. You should always compare interest coverage ratio year on year. You should ensure that the ratio is not less than 4 times and debt is not increasing over the 2 years. Along with all of this, earnings must grow year on year. So what are the 3 takeaways for the interest coverage ratio? Well, the interest coverage ratio has 3 takeaways. Number 1, the formula is EBITDA divided by interest expense. The second is that the ratio should be minimum 4x or 4 times. And the third one is ensuring that the earnings are always increasing year on year. Now, you have understood what interest coverage ratio is. Would you want to know its relation to debt equity ratio, which actually causes the interest coverage ratio? Well, click on the video above to understand more about the debt equity ratio.